Welcome to our webinar, Insurance Planning and Divorce. I'm Kevin Reardon with Shakespeare Wealth Management. Let's first look at the types of insurance that are available. Obviously, life insurance, disability insurance, property and casualty, and long-term care. Let's touch on a few of these items one at a time. First, on the life insurance side, typically have group life insurance. That would be insurance offered through an employer that covers a portion or a percentage of a person's wages. Individual life insurance, obviously you can go directly to an insurance company and buy insurance. The most common is either whole life, also called permanent insurance, and the second type is term insurance. Term insurance is good for a period of time, whether that's 10, 15, or 20 years as an example. Disability insurance, again, most of the time, employers would offer group disability. If you're disabled and unable to work, they will pay you a percentage of your income. Typically, that maxes out somewhere around 60 or 66% of your current wages. If you don't have disability insurance through work or you want additional insurance, you can buy that individually from an insurance company. Property and casualty is also called P&C insurance. That would cover insurance on property, things like auto, home, and boat. Riders would be things that would cover expensive items like jewelry. And then an umbrella is insurance that sits on top of those coverages and provides, obviously, added coverage. We see this typically for people who have higher assets, typically people who would have teenage children driving, where there's increased liability, or if you had a pool, a boat, other higher risk type assets. And then long-term care insurance is insurance that would pay in the event you're unable to care for yourself. So what is your insurance need? First and foremost, insurance is an absolutely invaluable financial planning tool. Divorce is terrible, but death and disability can be financially catastrophic to a family or to an individual. Frequently, the industry works with rules of thumb that indicate you should have 3 to 5 times life insurance, 3 to 5 times your income as part of your life insurance needs, or 8 times your assets, things like that. From our perspective, the best way to do that is through an analysis via your financial plan. So in terms of quantifying your insurance need, we'll look at all future and current assets, income, and expenses. Try to anticipate unexpected expenses or lumpy expenses like college, home repairs, things like that. Then we'll stress test your financial plan in the event there's a premature death, disability, or long-term care need. Insurance needs will change over time, and so it's important as we structure insurance that we do so accordingly based on your needs. Most of the time, insurance needs decrease as your assets increase, as you get closer to retirement, as your life expectancy is shorter, but not always. Sometimes there's actually an increased insurance need, especially if your lifestyle is increasing and increasing at a rapid rate relative to your assets. And also keep in mind, you may have good intentions to buy insurance today, but that insurability, your ability to get insurance may change based on a health risk or may simply go away if you have a health risk. So don't delay in getting the right amount of insurance. Some considerations, especially with divorce. When we're looking at a divorce situation, we want to calculate the present value of all future maintenance and child support payments to ensure that benefit accordingly. So as an example, let's say the monthly maintenance is $5,000 a month, and that's going to continue for 10 years. $5,000 a month times 12 months is $60,000 a year, times 10 years is $600,000. If the primary breadwinner passes away in that time frame, there will clearly be a shortfall, which we can cover through insurance. The divorce decree should really indicate the amount of insurance that needs to be carried on each party, as well as who pays for it and who the beneficiaries are. The divorce decree can also specify if one person wants to pay for more coverage on the other party. So imagine a scenario where there's two forms of life insurance: group life insurance and individual life insurance. The group life is only good if the person is employed or employed at that same income level or employed at a company that offers group life insurance. If that person changes careers, quits, or what have you, that benefit goes away. So it may be important to cover that person additionally out of your own pocket. Individual policies are in force as long as premium payments are made. So again, if an ex-spouse has life insurance, you want to make sure that they're continuing to pay the premium. One way to do that is to set yourself up as an interested party to receive confirmations that the policy is still in force. If you don't trust your former spouse or they're high risk, we would highly consider that you carry additional insurance on them, even if it's coming out of your own pocket. Beneficiary designations are hugely important, especially in scenarios where there's going to be or has been divorce. Beneficiary designations override what's written in a will. So imagine you've gone through a divorce, it's been final, you've written a whole new estate plan with a will, possibly a trust. If you haven't gone back to life insurance policies or retirement accounts and updated that beneficiary designation, it's possible that your ex-spouse is listed as a Benny. Frequently, we'll see people who have been divorced for years and years. They're in a new relationship with another person, but haven't yet married. If that beneficiary designation still lists the ex-spouse, it's very likely that upon your demise, that policy could go to the ex-spouse. So you'll want to look at life insurance policies. Individual policies are the most common or thought about, but again, those group life insurance policies offered through work. The current employer, don't forget if your ex-spouse switches employment, that beneficiary form should be properly filled out according to the divorce decree. And then retirement accounts, deferred compensation plans, all of those operate on a beneficiary designation and should be properly and currently filled out. So this is a little bit of a look at insurance needs during and after a divorce. If you have additional questions, feel free to reach out to us at any time. Thanks for listening.